Hello, this is Professor Michael Fournet, and this is the second lecture for week 7. This lecture focuses on interest rates and monetary policy. It's where we look at the Federal Reserve using its tools to influence the size of the nation's money supply. Right? So we want to look at how monetary policy can be used to either speed up or slow down the economy. And so we start by, first of all, defining precisely what is monetary policy. Monetary policy is where the Fed uses a variety of its tools that we will discuss to speed up or slow down economic activity. And the monetary policy path that the Fed takes will depend on what type of gap exists, whether there's a recessionary expenditure gap or an inflationary expenditure gap. That will dictate the type of monetary policy that the Fed will implement. For our purposes, we're going to restrict the influence of monetary policy to just investment expenditures, because as we learned in earlier material, investment is very interest rate sensitive. So when the Fed uses monetary policy, we're going to restrict its effects to just the business sector and investment expenditures. Now, to get a kind of a visual sense of how monetary policy works, we kind of need an environment by which we can kind of gauge how monetary policy is launched throughout the economy. And the perfect environment for observing monetary policy will be the money market or financial markets. And so you can kind of think of the money market as a market where the commodity money is both bought and sold. And to kind of conceptualize further, you bought money, for example, when you got a loan, and you buy money at an indicated interest rate. So when you get a loan, for example, you're buying money, you're a consumer of money, and you have to pay a price for it, and that price you pay for the loan is the interest. There's also a supply of money, and the supply of money, of course, is controlled by the Fed. But if you think of it on a personal level, selling money, you sell money, for example, when you put your money in a bank, and the account pays you interest. So you're literally selling your money to the bank for an indicated interest rate. So in that spirit, money can be bought and sold, and we want to look at the overall money market to get a sense of that process as it affects the economy. Now, in the money market, the money supply curve is depicted as being vertical, and this is just to show that the Fed controls a specific amount of money. So the Fed has a targeted amount of money, which I'm calling Q star, that it wants to be in circulation in the economy. And so the supply curve is vertical to show that the Fed has the exclusive control of the money supply. There's also the money demand side of the money market, and you notice the money demand curve is downward sloping, which implies that there is an inverse relationship between interest rates and the quantity demanded of money. Basically, if I want to borrow money as a consumer, the higher the interest rate, the less I'll be inclined to borrow. If the interest rate falls, which means that I can borrow money less expensively, then I'd be inclined to buy more. So at a higher interest rate, the quantity demanded of money is lower. As the interest rate falls, the quantity demanded of money would tend to go up. So the money demand curve has that downward sloping behavior like demand curves we discussed in earlier chapters. Alright, so the money demand curve can shift just like any other demand curve. It can shift. If it shifts to the right, it's called an increase in money demand. If it shifts to the left, it's called a decrease. And there are two factors that are indicated in your textbook that contribute to this shifting. One is called the transactions demand for money, where individuals need money to engage in transactions. So if I want to buy additional goods and services, that is, engage in transactions, my demand for money would increase. So when there's an increase in the transactions demand for money, it makes the money demand curve shift to the right. If there's a decrease or less of a need for money for transactions purposes, then the demand for money would shift to the left. So the demand curve would shift to the left. There's also another factor called the speculative demand for money. And the speculative demand for money simply says that different entities need money to take advantage of financial opportunities. So if I, for example, want to buy a stock, and in order to acquire this stock, I'm going to need money. I'm going to need money to speculate in terms of acquiring that stock. And so if the speculative demand increases, the money demand curve will shift to the right, because I'll need more money in order to speculate. If the speculative demand decreases, the money demand curve shifts to the left. Now, for purposes of this chapter, since our focus is on the Fed and conducting monetary policy, I'm going to assume that the money demand curve is stationary, and all our attention will focus on the money supply curve. And so the money supply curve can also shift. For example, if the entire vertical curve shifts to the right, let's call it increase in money supply. If the entire curve shifts to the left, it's called a decrease. And what will happen is, when it's shifting, the Fed is changing its target in terms of how much money it wants in the economy. So the Fed, having exclusive control over the money supply, will have the means for making the money supply increase, shift to the right, or decrease, shift to the left. Now, to make it shift, the Fed uses some of its tools, so-called Fed monetary tools. So the Fed monetary tools are the mechanisms that the Fed uses to make the money supply increase or decrease. And there are three that I'm going to focus on. The most prevalent monetary tool is called open market operations. And this, if you remember from Chapter 32, is overseen by the Federal Open Market Committee. And the Federal Open Market Committee, when they engage in open market operations, they will either buy securities or sell securities. So when the FOMC, on behalf of the Fed, buys securities, that makes the money supply bigger. So how does that work? Well, for example, when the Fed is buying securities, say it buys securities from some trader, some securities trader, it will acquire ownership of the securities and give that trader some funding. So maybe if you're using an analogy, the Fed maybe makes a deposit in the trader's account. Now, once that money hits that deposit hits the banking system, as we learned from the previous chapter, it results in the creation of money, because part of the deposit goes into excess reserves, that gets loaned out, and the money supply gets bigger. So when the Fed buys securities, it in effect makes a deposit within the banking system, and that makes the money supply increase through the money creation process. By the same token, when the Fed sells securities, it makes the money supply shrink. And that is, when the Fed sells securities, it already owns them, and it relinquishes control of those securities to, say, a trader, maybe a securities trader or a bond trader. And by giving the securities to the trader, the Fed gets compensated by pulling money out of the banking system. So the Fed takes money out of the banking system, it's like this massive withdrawal. And when the Fed pulls money out, that, of course, triggers the process called money destruction, where the money supply would actually shrink. So to keep it straight, when the Fed buys securities, the money supply gets bigger. When the Fed sells securities, the money supply gets smaller. Another tool that the Fed has at its disposal to make the money supply shift left or right is the discount rate. The discount rate is the interest rate the Federal Reserve charges banks for loans. So if a bank, for example, comes to the Fed to borrow money, the Fed will lend them the money if the conditions are appropriate, and the Fed will charge them an interest rate, and the interest rate is called the discount rate. So if the Fed lowers the discount rate, it makes it less expensive for banks to borrow from the Fed, and that would tend to give them more funding, more money. And so when banks have more money, of course, they're going to try and loan it out, and that would make the money supply increase. By the same token, if the Fed raised the discount rate, that would discourage banks from wanting to borrow from the Fed. That would tend to cause the money supply to shrink, because the banks would have less funding which to loan out, and that would have a negative effect on the money supply. So if the Fed lowers the discount rate, the money supply goes up. If the Fed increases the discount rate, the money supply goes down. By far, the most powerful tool of the Federal Reserve is the reserve ratio, which I identified previously as little r. And it really just takes minute changes in little r to have really amazing effects on the behavior of the money supply. So if, for example, if the Fed lowers the discount rate, that then means that banks can have more of a deposit in excess reserves. And so the more money in excess reserves means more loaning. More loaning means more money creation. So if the Fed lowers the discount rate, it will cause the money supply to increase. By the same token, if the Fed increases the Fed lowers the required reserve ratio, that will cause the money supply to increase. If the Fed raises the reserve ratio, that means that banks have to hold more in required reserves, which means they have less in excess reserves. Less in excess reserves means less loaning, and so the money supply would tend to shrink. So these are the tools that the Fed uses primarily to influence the money supply, to make it shift left or right. Alright, and so focusing strictly on Fed behavior, if the Fed, for example, were to lower the discount rate, then the money supply curve would shift to the right. If the Fed were to sell securities, then the money supply curve would shift to the left. Now, as the money supply curve shifts, notice our definition of money market equilibrium changes. With the initial supply curve here, it gives us an equilibrium interest rate, which I'll call I sub r. So IR sub E. So interest rate at equilibrium. Now, when if the Fed were to use its tools to reduce the money supply, interest rates would go up. And it makes sense practically, because when there's less money available, its value goes up, its cost increase, its price increase, which is the interest rate. By the same token, if the Fed uses its tools to increase the money supply, there's more money available, and since there's more of it, its value or cost tends to go down, hence interest rates tend to fall. So when the Fed uses its tools to change the money supply, increase it or decrease it, that's going to affect the level of interest rates. Alright, and so now the stage is kind of set for looking at the different types of monetary policy, because as interest rates change, that will influence spending, investment spending. So when it comes to monetary policy, there are two types. There's expansionary monetary policy, which the Fed goes down this path when you have recessionary conditions. The Fed is trying to make the economy expand, to try and grow out of the recession. The other path the Fed can take is called restrictive monetary policy, and the Fed goes down this path when the economy is growing too fast, and it tries to restrict growth by engaging in restrictive monetary policy. Now, so again, the monetary policy is where the Fed changes the money supply. So changing the money supply, increasing it or decreasing, that's monetary policy. That's the Fed doing that. Now once it does that, it then has an effect on interest rates. And as interest rates start to change, that then starts to influence economic activity. So when the Fed is using monetary policy, expansionary or restrictive monetary policy, it's going to be changing interest rates in the economy. And as interest rates change, that will influence the level of spending. Alright, so kind of looking at precisely what happens when the Fed engages in expansionary monetary policy. The Fed uses monetary tools, open market operations, the discount rate, the reserve ratio, in this case it will use the tools to make the money supply increase. So use those tools to make the money supply increase. As the money supply becomes more plentiful, interest rates start to fall. As interest rates fall, spending, such as investment spending, will go up. Now when investment gets bigger, and investments are part of aggregate expenditures, aggregate expenditures increase. And as aggregate expenditures increase, the disparity between aggregate expenditures and real GDP at full employment gets smaller, and the recessionary expenditure gap starts to close. So the Fed uses its monetary tools in the case of expansionary monetary policy to increase the money supply. And by increasing the amount of money in the economy, that revs up spending activity, particularly investment, and that helps the economy to grow out of the recessionary conditions. The recessionary expenditure gap closes. In the case of restrictive monetary policy, it's basically everything in reverse. The Fed again uses its tools, but it uses its tools the opposite way. So for example, like in the case of expansionary monetary policy, instead of the Fed buying securities, in the case of restrictive monetary policy, the Fed would sell securities. And by selling securities, the money supply would shrink. As there's less money available, the price of money, interest rates, start to rise. As interest rates rise, investment spending cools off. It starts to decrease. And as investment is getting smaller, of which investments are part of aggregate expenditures get small as well. And so when aggregate expenditures decrease, the disparity between aggregate expenditures and real GDP at full employment decreases, and the inflationary gap closes. Remember, when you have inflationary gap, aggregate expenditures are going to be larger than real GDP at full employment. So the trick is to reduce expenditures to where they coincide with real GDP at full employment. And if the Fed is capable of doing that, then the inflationary expenditure gap closes. Alright, now another kind of issue that was raised in the chapter is something called the Taylor Rule. And the Taylor Rule was developed by Stanford economist John Taylor. And it's basically just some guidelines that the Fed could adhere to. Again, the Fed is not required to listen to John Taylor or anyone, but these guidelines have really been pretty clever in the sense they kind of tracked kind of the Fed's behavior when it comes to the federal funds rate. And so the Taylor Rule is really just guidelines that the Fed could adhere to in its quest to properly set the federal funds rate. Now, it works like this. If the economy is growing too fast, we know that's going to cause inflationary conditions. And so what you want to do is you want to slow the economy down. And one means for doing that is to make the federal funds rate higher. The federal funds rate, of course, is the interest rate that banks charge each other for loans. And so if that interest rate is higher, then they have less of an incentive to borrow from each other, because they're borrowing primarily for purposes of supplementing their excess reserves. They want to make loans. So when the economy is growing too fast, where real GDP would be exceeding potential at full employment, the federal funds rate should be increased. And so the Taylor Rule gives guidance of how much to increase the federal funds rate to slow down the economy. By the same token, if the inflation rate that we're observing is actually higher than the inflation rate that the Fed is targeting, the federal funds rate should also be increased in that instance, because there the economy obviously is overheating, as evidenced by the inflation rate exceeding the target inflation rate. And so if you raise the federal funds rate, that will help cool down inflationary pressure. And so the Taylor Rule gives guidelines about how much to increase the federal funds rate when the economy is growing too fast, and how much to increase the federal funds rate when inflation is above a target level set by the Fed. Now, of course, it works in reverse. If the economy isn't growing fast enough, or if inflation is below the target level, then you would want to lower the federal funds rate so as to stimulate economic activity, spending. And so the Taylor Rule gives guidelines for how much to lower the federal funds rate when the economy is growing too slow and when inflation is below the targeted level. So the federal fund, so the Taylor was really a very clever mechanism for offering policy assistance to the Fed to help them set the federal funds rate at a level that's appropriate given the prevailing economic conditions. Okay, so these are the main topics discussed in Chapter 33. Again, this is the second lecture for this week. The first lecture focused on Chapter 32, where we looked at the money creation process. So this chapter is really an extension of Chapter 32, because once money was being created, we wanted to see how that change in the money supply would affect the larger economy. And so Chapter 33 was a nice way of looking at the Federal Reserve's role when it comes to the influence of money in the economy. Alright, so that concludes this lecture. Please take a look at the exercises. Please review these videos as much as you need, because the Federal Reserve is a very fascinating organization, and some of their work in terms of studying the economy is truly fascinating. So I hope that you will develop an appreciation for the Federal Reserve and the role they play, the critical role they play in our economy. Alright, until next time, take care.